Hello everybody, and welcome to part 12 of our series, Understanding Binary Options. This relatively short video titled Investor versus Investor takes a look at binary option trading from a slightly different perspective than what we're used to. This time around, we assess binary option trading from the perspective of binary option trading platforms themselves, and we take a look at how sometimes these trading platforms can directly or inadvertently end up pitting one investor against the other. So let's begin, as we always do, with a quick overview of binary option trading. Essentially, given a commodity or currency or stock or index, each of these has a current value at any given point in time. Binary option trading relies on our ability to predict what that value is going to be sometime in the future. We call if we think the value is going to go up, and we put if we think the value is going to go down. Being right gets us a percentage of what we put in, while when we're wrong, we lose all of what we put in. Let's take a look at a quick example. Let's say we invested $100 and we denote this by A, which represents the amount, and let's say we were right. Whatever our decision was, whether call or put, we were right. Let's say the rate of return R was 80%. Therefore, we need a profit of $80, which is just 80% of 100. And our profit for any given trade can be computed by A times R, where R in this case is the percentage represented as in decimal format. But where did our profit come from in this case? The general understanding is that the trading platform is incurring the loss. In other words, whenever we're right, the trading platform is what ends up giving us our money, and whenever we're wrong, we give all of our money to the trading platform. But let's dig a little deeper into this, and let's try and list out who the various players are. So there's, of course, the trading platform, and what it does is it facilitates the trade for any given commodity. And then there's us. We're the investor, and we take part in the trade. If we're wrong, we end up giving all of our money to the trading platform. But if we're right, the trading platform gives us a fraction of the amount that we put in. So we get back all of what we put in, and we also get a fraction as a profit. But is that the only model taking place? What happens if for any particular trade, we're not the only ones that are trading? So again, we have the trading platform, which is facilitating the trade. And let's say this time there's two investors. There's investor 1 and investor 2, and they're both taking part in the same trade at the same time. Well, that's a given that it's the same trade, because trades on binary option trading platforms, they expire. So it's taken for granted that it's the same time. Now let's just say, hypothetically, investor 1 is the loser, and investor 2 is the winner. Now what would happen here? Investor 2 would get some money, let's just continue our example, would get 80% of the amount that they put in, and they would get that money from the trading platform. On the other hand, investor 1, the loser, would lose all of what they put in, and they would give all of that money to the trading platform. So in essence, the trading platform would be getting money from investor 1, but giving money to investor 2. So does that money necessarily need to come from the trading platform? What if it took place in this way? What if investor 1, and let's just, for the sake of example, say investor 1 and investor 2 bet the same amount. What if the money that investor 1 put in and lost, what if 80% of that, since they bet the same amount, what if 80% of that just went to investor 2? Does that mean investor 1 gets to keep that remaining 20%? No, investor 1 ends up giving that leftover 20% to the trading platform. So in this scenario, we have two different investors, two people who are interested in this trade. One of them won, one of them lost. In this case, one would expect that the trading platform got a little money, also lost a little money, but no, what really ended up happening is that the trading platform made money. No money actually passed from the trading platform. It just need not have made as much money if both people had lost. So let's take a deeper look at what this really means. What's really going on here? Assuming that the outcomes of trades are perfectly random, and I think this is a fair assumption if we're not trying to be biased. If I was biased, I would say they're anything but random, but let's assume that they are random. Therefore, as an investor, we're expected to be right half of the time and wrong half of the time. That's totally fair. What this means is that for any given trade, when multiple people are involved, half of us are expected to be right, and the other half are expected to be wrong, on average. But the trading platform is always expected to make a profit. How does this happen? because it uses one investor to effectively compensate the other, but it always ends up keeping a share. Because, and again, this is the fundamental underlying notion behind a lot of these binary option trading platforms, when you win, you get a percentage of what you put in, but when you lose, you put all of what you put in. So there's a difference in terms of the profit and loss, and that difference always ends up getting pocketed by the binary option trading platform. Now, is it possible that the binary option trading platform still makes losses? Yes, technically it's possible. It's possible. Just because one person wins doesn't mean the other person can't also win. It is possible for multiple people to win, but by the same token, it's also possible for multiple people to lose. So on average, again, the trading platform would end up winning, and that's the reason I ended up using the word house, because this is very, very similar to something that's staging a bet, so to speak. And assuming everything is fair, assuming everything is even, no matter if the trading platform incurs some losses sometimes, it's still going to end up making a profit just about on every bet, because half of us are expected to be right and the other half are expected to be wrong. And often enough, as traders, we're probably fighting one another. Just based on these statistics and based on the assumption that we're not right any more than we are wrong, and half of us are right and half of us are wrong. Whenever some of us are right, the money that we get comes from those of us who ended up being wrong. But not all of the people who ended up being wrong give their money to us. They end up giving quite a bit of it. In our example, at least 20% of it to the trading platform, and therefore the trading platform always ends up making money. When I say always, is always expected to end up making money. So that's about it for this video. It's, like I said, it's going to be a short video. It just puts a slightly new spin on binary option trading. It's something we haven't talked about before, and some of you may already have come across this and realized this. In essence, the idea of multiple people being involved in the same trade and indirectly being pitted against one another is no different from any kind of auction, especially penny auctions, where in the end, based on one person's loss being another person's gain, no matter what, from the trading platform's perspective, they're agnostic. They don't care which one of us wins or which one of us loses. They're gonna always end up making a cut. And I just wanted to highlight this aspect of binary option trading, and that's about it for this video. As always, if you enjoyed it, please like, please subscribe, and if you have helpful comments, please feel free to leave them. And I guess I'll see you in our next video. Thank you.